Okay, good afternoon, everyone. My name is Sarah Baton-Khan. I'm with the Office of Financial Empowerment at CFPB, which is part of the Division of Consumer Education and Engagement. This panel is titled Improving Information and Access for Consumers. So now that we've heard about some of the challenges consumers face gaining or regaining access to accounts that financial institutions offer, we're going to shift gears to hear about some solutions that have been developed over the years in response to the issue. So these are programs and initiatives designed to help consumers either regain or gain access to the system through products designed to meet their needs, as well as information. And the information has a few different purposes. One is to help consumers identify the best products for them, also to help consumers be successful in those accounts. And third, how to regain access to the system for those who have been screened out. So we heard some examples of that in the last panel, but that could be helping a consumer walk through the steps of pulling their report, identifying if there are errors. If they're not errors, then helping them to understand how to pay back what they owe to the bank or the credit union. So we have an impressive panel. This group represents a mix of representatives from local and federal government, industry, and nonprofits. Let me introduce the panel. First, we have our moderator, Louisa Quitman. Louisa is Director of the Office of Financial Education at the U.S. Department of the Treasury in the Office of Consumer Policy. She's responsible for policy development and coordination related to promoting the financial decision-making of Americans. She coordinates the interagency FLEC, which is the Financial Literacy and Education Commission, and the President's Advisory Council on Financial Capability for Young Americans. She also oversees the research for her office. And prior to Treasury, Louisa was program manager at the CDFI Fund. Next, we have Dara Duguay. Dara is Executive Director of the Credit Builders Alliance, which provides nonprofits with the ability to report loan data to credit bureaus, as well as pull low-cost client credit reports for financial education purposes. Prior to joining the Credit Builders Alliance, Dara ran her own consulting practice and advised clients such as TD Bank, the World Bank Group, Experian, and SunTrust on financial education topics. She's also served as the Director of Citi's Office of Financial Education and the Executive Director for the Jumpstart Coalition for Personal Financial Literacy. Next, we have Janet Gordon. Janet serves as Associate Director for Community Affairs in FDIC's Division of Depositor and Consumer Protection. In that role, she's responsible for oversight of FDIC's financial education programs, which includes Money Smart. I'm sure many of you are familiar with Money Smart. She also coordinates the FDIC's community affairs teams across the country, which support economic inclusion initiatives focused on low and moderate income consumers. Roger LaCruz is the Vice President and Senior Product Manager for Retail Deposits at Union Bank. He's responsible for developing and executing the bank's emerging or LMI segment product strategy. Roger currently manages retail products and alternative financial services focused on unbanked and underbanked consumer segments. And in that role, Roger is the lead designer of the Union Bank Access account, which you'll hear about in a minute. He has over 15 years of product management experience in debit, ATM, and retail deposit products. So let me just say before I turn it over to Louisa that I think these are really important efforts you're about to hear about, and this was highlighted in the past two panels, considering how we know this is such an opaque system and consumers really don't know much about it. So these efforts have been really important in elevating the issue and elevating information that's passed on to consumers. Oh, Lee. I know. Oh, I'm so sorry, Lee. Okay. And Lee's a friend of mine, too. So Lee Phillips, last but not least, is the director of the San Francisco Office of Financial Empowerment, which is part of the Office of the Treasurer for the City of San Francisco. She's worked for Treasurer Jose Cisneros since 2004, and in that role, she's created the Office of Financial Empowerment at the city level, and she's also implemented major initiatives, including the very first Bank On program. We heard a lot about Bank On today, Bank On San Francisco, joinbankon.org, and kindergarten to college. She received the James Irvine Foundation Leadership Award in 2008, and last year was named one of the Bay Area's top 40 under 40. Okay, so with that, I'll hand it over to Louisa.
Thanks, Sarah, and thanks to the CFPB for pulling this event together today. So it's a privilege to be here with this august panel, and it's a privilege to be joining you as you have your lunch. But I think what we'll really try to do is make this last panel really I think, the most exciting panel, because we're really going to be talking about solutions. What the federal government can do, what cities and communities can do, what nonprofits can do, and what financial institutions can do to really address this issue of people out of the financial mainstream and how we can seek to bring them in. I think that we heard certainly the first two panels were really great, gave us a lot of great examples of what is already happening in this space. So I'll ask this panel to tell us what they're doing, to talk about maybe how they came about it and where they think these approaches can be going, but also maybe to push it a little bit further beyond just opening accounts and helping people use them successfully, but also to start to look at broader issues of financial inclusion and financial stability of American families, since this is an issue that really does speak to financially fragile families and financially fragile individuals. So we might go a little bit beyond just opening accounts on this panel. So let me just take a minute to really talk a little bit about the history. I think Sarah asked me to do this. Is really, I think you heard this from Anthony on the last panel and others, that over the last decade, communities such as those leading bank-on initiatives have really been really faced with coming up against, as Jonathan described, the brick wall of people wanting to open bank accounts, people being encouraged to open accounts, led down that path, and then encountering the barrier to opening accounts. And for a long time, practitioners in the field really didn't even know what was happening. They didn't know to the extent that people were facing these barriers. Where they were being faced, who was facing them. So I think this is still a relatively new area for all of us who are interested in financial capability and financial stability of our families to really understand what is happening, to what extent it's happening. And I think the FDIC has really, when they first did their first survey, household survey in 2009, really gave us a broad base of information. And I know Janet's going to talk a little bit about that information to start putting some concrete numbers on who these people were who were not in the banking system and some of the reasons why. And certainly they'll, really unearth this number that about half the people who were unbanked were people who previously were in the banking system. And I think the communities on the ground, whether it's in San Francisco or in Los Angeles or all across the country, where they are trying to bring people into the financial system, are disproportionate, are connecting and seeing that people are out of the banking system, hearing the stories like Anthony mentioned, that people have an attitude that I'm never going to be able to open a bank account. Banks don't want people like me. And I think I haven't heard it said today, but these are really disproportionately affecting minority communities. So maybe the panel can talk a little bit about that as well. But I think there's also been a lot of great solutions at the local level, in community organizations, in financial institutions, and at the federal level. I think it's worth noting that back in 2010, when the National League of Cities surveyed bank-on programs at that point, over 80% of them indicated that some sort of account access to people with account screening records was part of that program. And some of the services that were being provided or required were things like financial education, flexible restitution policies, and ignoring records more than 6 or 12 months old. And just one example that we saw at the time, Bank on Jacksonville was working with the University of Florida Cooperative Extension to provide a one-day workshop to people, after which they received a certificate that they could take to a participating bank or credit union and open an account. So I think certainly financial education can be part of our conversation, and though my title includes financial education, I'm certainly not here to think of that as a panacea to the situation that we're facing. I think many of the programs that we will hear about include an element of financial education and making sure consumers have an understanding about how accounts work, as the last panel talked about, and have access to sound and safe financial products. Again, the last panel talked about that. I think, though, it's also important to put this work of opening accounts and addressing barriers to opening accounts in a broader framework of helping Americans deal with the broader financial stability issues that they're facing. And I hope that the panel will help us think about more holistic approaches that help people not just open accounts, manage them successfully, save for emergencies, save for the future, and also build and repair credit and have access to appropriate credit that they need to manage the liquidity challenges in their lives. And then finally, I'd like the panel to think about how we look at the youngest households. We know that the youngest people under 30, are the least likely to be using financial institutions. They're the least likely to have bank and credit union accounts. And yet even 40% of those young unbanked households are previously banked, and we heard some indications that they might already be facing barriers to opening accounts. So I hope the panel will also make sure that we address the young people who, if they're facing challenges now, what is it going to look like in 10 or 20 years from now? So those are some of my goals for this panel. Let me start by asking each of you on the panel sort of how you came to see this issue of account access challenges and what you're doing about it. And then maybe talk a little bit about sort of how you came into this issue and where you see your work going. I'm going to let Janet start by kind of giving us some of the data framework that the FDIC has unearthed and talk a little bit about what you're doing at the federal level.
Sure. Good afternoon, everybody. Keep chewing. It's okay. We'll talk through it. The FDIC really has a multi-part approach to economic inclusion. We do research to better understand the unbanked and underbanked through our national survey. We work very actively to encourage financial institutions to offer safe transaction accounts. I think we've heard about that today, and I'll talk a little bit later about it. That are particularly designed to meet the underserved consumers' needs. We work through our community affairs group to help across the country in forming coalitions at the local level, at the state level, and to provide technical support. And finally, we also do a lot of financial education and financial capability development, and some of them with CFPB, Treasury, others in this room. I want to start by talking about why we think this is important going into the data that we've collected, and then talk a little bit about the Safe Account product, and then we can double back on some of the other issues. I think it's been made very clear today that for consumers, a bank account serves that basic, essential entry into the financial system. People have talked about it. It's really important for the ability to manage household finances, a platform to build essential savings, a credit record, all those things. For financial institutions, interestingly, we heard a lot today about how financial institutions see it as an essential element of their customer relationship, sort of getting on the ground with the customer, serving that customer. So the FDIC has the mission of promoting public trust and confidence and the stability of our financial system. So one of the essential reasons we do this economic inclusion work is because we believe it's very important that the widest possible segment of the American public be served by insured depository institutions. And that is not only for their benefit, for the benefit of the system as a whole, and that those deposit insurance features and the customer and consumer protections that are associated with mainstream financial institutions are really an important element of public trust and public confidence in our overall financial system. So we understand economic inclusion as a ladder where bank accounts and financial knowledge and education are sort of the first rungs. You develop savings, you develop other assets, you perhaps get included in the home ownership opportunity. Financial institutions may even serve your small business needs, and over time you build assets and become part of the financial mainstream. So the data indicates that we still have a way to go in terms of incorporating people into the financial mainstream. We're about to release our 2013 survey. Stay tuned to economicinclusion.gov, and we will be doing that on October 29th. The 2011 data indicate that about 8% of Americans lack any kind of banking account, and 10% of households surveyed lacked a checking account. But underbanked households and unbanked households are overrepresented in minority groups. So it's for about 20% of African American and Hispanic households are unbanked. They don't have any kind of bank account. So keeping that in mind, also keep in mind that, as Louisa pointed out, about half of unbanked consumers were previously banked, and for a variety of reasons did not sustain a banking relationship. And then the other half have never had an account, obviously. So what are the real reasons that people don't have an account? They report that they either feel they don't have enough money for an account, or perhaps that they don't need or want one. Some also report leaving banking relationships because of high costs and fees, and others report the sort of institution closed my account. So all of those reasons are part of the picture. Households that previously had a bank account are more likely to want one again. So people who've had bad experiences still tend to want to open a bank account, but of all the unbanked households, only about a third say they are very likely or somewhat likely to open accounts in the future. And I think that tells us that we do have a trust issue. We have a barrier that is not just, that it's not going to be simple. The solutions are not going to be simple in order to overcome. So that's the baseline data. You've heard a lot about safe accounts already today. One of the key initiatives that the FDIC put forward, working with its advisory committee on economic inclusion, is the model safe account template. We began to work on that in 2010. We did a pilot initiative with about 9 banks in 2011. And now we are seeing an increasing wave of institutions joining the flow of wanting to organize to offer safe accounts. They may choose several different approaches to that, but in recent months we've seen a lot of increased adoption by both regional and national institutions. And KeyBank this morning talked a lot about its approach. Roger, I'm not going to take too much of his thunder. He's going to talk about it. And I just want to say that this is an essential part of improving access, and it's an essential part of sustaining access, because these accounts are checklists. They're generally card-based electronic accounts. Withdrawals are allowed through automated tellers, through POS, through automated clearinghouse. They have very low opening balance requirements. They have low monthly balance requirements. And very importantly, such bank accounts, those that conform to the FDIC's template, will not be able to result in overdrafts or NSF fees. So this is a key element in the sustainability. It also eliminates the float problem and increases the predictability. So we're very excited to see these accounts catch on. Nonprofits and others reporting up through our community affairs network indicate to us that they haven't caught on enough, and we're encouraging folks to step up. So with that,
So I think you set it up very well for Roger to talk a little bit about what you're doing at Union Bank, how you kind of develop the product that you think serves this need, and what you're doing with it.
Great. Thank you for having me here, and I'm glad that you started talking about the Access account. To start, let me just share with you that in an effort to demonstrate the commitment from our bank, Union Bank, to responsible banking, back in 2013, we developed the Union Bank Access account. We leverage a lot of information from the FDIC that tell us about the unbanked and underbanked, but we're taking one step further, where we also include people that were previously banked or people that are new to banking. So what we did is we developed a product, and we knew that one of the challenges in creating a product for the unbanked or underbanked is because we knew that there was this thing called ChexSystems, that a lot of them would not qualify to have an account, a regular account that will be safe. So when we're building the features and functionalities for the product, we develop a low-cost product that offers features that will prevent the customer from getting into trouble. So mainly we put guardrails in this account to ensure that the customer did not get in trouble with the account mismanagement or have minimize the possibility of fees like overdraft and non-sufficient fund fees. So what we did is we blocked those fees. So if the customer doesn't have enough money in the account, the transaction does not go through, the customer does not have overdraft. So they're safe. But in addition to that, we also make the account the possibility that if a customer wants to open an account and they were previously in ChexSystems, we will allow the customer to open the account. The only requirement that we have is that if the account is on ChexSystems due to fraudulent activity, we will not open the account. And I think today we learned the many reasons why. It's hard for us as a financial institution to understand or know why this customer was reported to ChexSystems due to a fraud flag. It's hard for us to really go back to whatever institution report the customer or whatever the customer did or didn't do to be in that system. So, but I think that addressing the fact that some customers do get into trouble with ChexSystems and they deserve a second chance to do it right, we figured that it was the right approach for us to allow some of these customers to open the account. So our main features of our account is, as you guys heard it before, is the overdraft. We do not have overdraft fees. The second good feature is that if you're on ChexSystems, you can open the account. And the way we did this, we looked at research and tried to figure out why sometimes people get into trouble for ChexSystems. And one story that I want to share with you guys is that sometimes you have banks that offer accounts that you can open an account today for $1. And you go to your local fair and you open an account for $1 and you have this checking account. But if you're 18 or 19 and you think this is a good deal and then you get a free t-shirt for opening that account for $1, within 30 or 60 days you realize that you're getting these letters, which are negative letters from your bank saying that you only had $1 and we charge you $8 for the monthly fee, now your account is negative, and if you don't pay us an additional $33 for an overdraft fees, your account will be closed. So as an 18 or 19-year-old that has not familiar how to manage an account, you're probably gonna walk away from that account saying, I don't want anything to do with that because now they want more money from me. So when we build this account, when we try to figure out what was the initial deposit, we wanna make sure that we did a deposit that will be good for the customer to get that account established and start using the account. So we require a minimum deposit of $25. This account is a $5 monthly fee if you have direct deposit. If you have online statements. If you don't have online statements and you want paper statements, it will be $6. But if the customer has a direct deposit, the account is completely free to the customer. So then when we design the account, we want to make sure that the customer has enough time to set up the account, to start using the account, so they can not have any negative overdraft fees associated with the account. So by doing that, the customer has the opportunity to open the account, get it established, and the first letter from us will be, you have opened this account 30 days ago, there's $25 fee. If there's a monthly service charge, the customer has $20 and has time to realize that if this is something that the customer wants to keep or not. And if they do not want to keep the account, they'll go ahead and close the account. No harm, no foul. They can open an account 3 years later if they decide to open a checking account with another institution. So some of the things that we were looking at when we built this account were really to try to make sure that we have guardrails on the account to ensure the customer does not get into trouble. So let me stop there before I take too much time.
Great. Lee, why don't you talk a little bit about sort of what all the different things that you've been working on in San Francisco, but I think you probably want to start with one.
Thank you. So I just wanted to start off by saying I'm very glad to be here today. This is actually a conversation we've been wanting to have for some time, and we're very grateful to the CFPB for convening us today so we can begin this dialogue. I'm actually going to start by telling you a little story that my colleague Anne Stuhldreher, who is formerly with the New America Foundation, gave me permission to share with you this morning, although I didn't tell her it was being live streamed, so sorry, Anne, if you're watching this. So Anne, when she was at the New America Foundation, brought actually the original idea that became Bank on San Francisco to the city and county. And some of the reason that she decided to do that is that she herself had a ChexSystems issue in the past. She had an account in one city which she closed when she moved to a new city and didn't realize that a friend that she'd written a check to for $2.80 had never cashed that check. 5 years go by, Anne moves again, this time to New York City, and goes to open a new account and is told that she's been flagged for account abuse because her friend cashed the $2.80 check after the account was closed, and of course that bounced and the issue was never resolved. So I guess you could say that all's well that ends well, and the fact that this brought this issue to Anne's attention, and that she then went on to become quite a strong advocate for consumers in this space. So the story continues when, with Anne at the New America Foundation, brings the idea for Bank on San Francisco to the city and county, and came to our office, the city treasurer's office, because we manage all of the banking relationships with the city, and said, Mr. Treasurer, we'd like to help bank some of the 15% of San Franciscans who are currently unbanked. We also know that that was disproportionately affecting the African American and Latino communities, where about 50% of our residents in those communities were unbanked. So this really led us to this process of looking at what were the real barriers to banking, and Janet's mentioned some of them this morning. Then we talk a lot about fees, about accessibility or geographic locations, so on and so forth. But we also looked at two very strong actual hard barriers, institutional barriers that were blocking people from banking. The first of those was identity and documentation, so people having the right kind of IDs necessary to open an account. But the second issue really was what we're talking about today, which is people who are effectively blacklisted or blocked from banking. Back in 2005, we did manage to get our hands on some data that showed the prevalence of this issue in San Francisco by zip code. And as Jonathan Mintz mentioned earlier, today, it's not a very small problem. In fact, it's quite large. The highest percentage we saw in one zip code was 25% of residents had a negative history for banking, and I'm sure it won't be a surprise that that is a predominantly low-income and minority community in San Francisco. So the fact that we therefore have 1 in 4 in a certain zip code, and the numbers vary across the city, really flagged this as a major issue. And I would like to add, actually, while I'm talking about this, put out a call there. I'd like to see this data actually more broadly for how prevalent is this issue across the United States. And I haven't seen it. I don't know if anyone here has, but I'd really like to see something like that broken down by zip code so we can get a better understanding of this issue and its impact. So we're looking at the barriers. Of course, we convened the banks to form what would become Bank on San Francisco, and we met with our banking partners over about a 9-month period, and we brought our list of here are the barriers to banking, how can we work collaboratively to resolve those. And our bank partners and credit union partners really participated with us in good faith, and I think that's very important to note. And we came out with a solution to this issue that to participate in Bank On, there's a set of criteria, and one of those would be you had to offer an opportunity for second chance checking. So you couldn't just deny people across the board if their name was flagged by an account screening CRA, that you actually had to have a way in place to work with the consumer. We heard our bank and credit union partners where they said they didn't want to bank people who had a history of fraud, and we agreed that that was reasonable. We also agreed that anyone who had been flagged on ChexSystems or a similar system within the last 12 months could be required to take some kind of training before they would be able to open an account. But if it was older than 12 months, then the banks or credit unions would open those accounts. And we thought, okay, that sounds good. So we have our set of criteria. We have 15 banks and credit unions signed up. Many of the major banks signed up. And we launched the program, and it didn't take long before we started hearing from consumers that some of these issues around second chance checking were being raised. And the consumer experience tended to be a lot different than what we were anticipating. We had folks just go into banks. We had one woman called me and was told that the bank wouldn't help people like her. Actually, to be fair, that was a credit union. We started to get these types of phone calls. And one of the other issues that we weren't anticipating was that people in San Francisco who we were training and were actively participating in the program, as I said, our banks and credit unions were really enthusiastic about this work and really wanted to help, but their corporate offices were closing accounts sometimes as fast as they were opening them on the branch level, and that was another issue too. So the branch manager would sit down and say, yeah, I think I can help you out. We're part of Bank on San Francisco. And then the client would walk out of there thinking they had an account, and a week later would receive a letter from the corporate office telling them that their account had been closed because of a negative banking history. So I would say that this has been probably one of the most difficult challenges that we've faced locally with the Bank On program, and part of that really is it's very difficult for us to explain to consumers what the situation really is at all of these different financial institutions. So we survey all of our banks and we ask them for information about their products in order to meet the criteria to get into the Bank On program. And one of the questions we ask is, what is your policy around ChexSystems or screening customers? And there's a really wide variety. So obviously we've talked a lot this morning about fraud. Another one big issue that has come up and comes up for us consistently is lack of clarity around restitution. So one bank A may say, we only care if you owe money to us. If you owe money to another bank, that's fine. Another bank will say, if you owe money to any bank, we won't bank you until those issues are resolved. So from our perspective, it actually becomes very difficult to advise consumers about where to go and what to do. And the best answer we have oftentimes for people is, there are 2 community development credit unions in Bank On, and if you think you have an issue, you can go there. So I'll stop there for now, but those are just some of the big issues that we're seeing on the ground.
So Dara, I know your solutions are working with community-based organizations who are very much on the ground working with individuals. Can you talk a little bit about what you all are doing?
Sure, hang on. I think I'm the only person here with a PowerPoint. You know, you can't talk unless you have a PowerPoint, right? It's impossible. And so I wanted to start with, you know, why is CBA here? Because we're not talking about credit today. And so I wanted to explain how we got into the whole area of ChexSystems. But first, I just wanted to back up a little bit and talk about why we were founded. We've been around since 2006. There was a group of community development financial institutions that were giving microloans to primarily low to moderate income individuals. And they were very concerned that they were not able to report the loan payments to the credit bureaus and help their clients build credit. And the reasons for that were several. There were threshold requirements. If they were a small lender, they usually didn't have a big enough portfolio. And also, quite frankly, the credit bureaus had a lot of concerns about the nonprofit's ability to be able to report accurate data. And so CBA was really formed to be that intermediary. So that's the role that we fill right now. And if you can take a look at the little slide up there, we are, in essence, the intermediary between our nonprofit members. We currently have 410 nonprofit organizations. Many of them are microlenders, but not all. But all are engaged in some type of financial education, financial coaching, so all interested in credit building in general. And so we are the liaison between those groups, those 410 groups and growing every month, and the bureaus. We have had a relationship since the beginning with TransUnion and Experian, and I think there's a couple representatives from Equifax in the room. I'm thrilled to say that Equifax finally, after many years, has decided, yay, to accept our members' data. So all of our members' data is going into all 3 of the major credit bureaus. Now, why is this important? Experian did a pro bono analysis of our members' data over the summer, and they went back in time. All of the loan portfolios that we receive every month, we batch up and forward them to the bureaus. They're all coded as Credit Builders Alliance. So it's actually very easy to go back in time. And they looked at a population of 3,000 low-income borrowers, and they wanted to see what was the impact of having this microloan reported to a bureau. And the impact was huge. And 2 of the major findings is that 20% of those in this cohort of the 3,000 moved to a lower risk category. So what does that mean? They moved from subprime to non-prime, or non-prime to prime, or from unscorable to subprime, and we all know that that really affects their cost of credit, right? So you've all heard the saying that it's expensive to be poor, and it really is. And so being able to move to a lower risk category really makes a huge difference. And then the second major finding is that they found out that they had thicker files. So why does this matter? Most of the clients that our members help are credit invisible. We've heard that term. If you pull their credit report, you'll see nothing. And it's really hard to get a loan if you don't have a credit history. It's one of those, catch-22s, just like a job. You can't get your first job till you have experience. How do you get experience, without having your first job? And the same thing applies for credit. So we were thrilled that we found out that the vast majority of the recipients in this data study were able to increase the thickness of their file by 3 to 5 additional loans, meaning that by having the existence of this one trade line, that they were actually able to qualify for additional loans, which in the past they probably would have been denied. So that was very exciting. Okay, so I wanted to give sort of a background and explain how we got to ChexSystems. Because our members deal primarily with 85% of their clients are low to moderate income individuals. They do a lot of hands-on intensive coaching. They really follow them, and they have a holistic view. Instead of just giving them a loan, it's usually paired and coupled, as Nancy explained earlier, with financial education, and that's the best of all worlds, right? So you lump it sort of together, the education with the product. And what they were finding is they were finding that many of their counselors really didn't know how to coach people that were having problems getting a bank account. So they actually asked CBA if we would be willing to create an educational module to help them with understanding how to help their clients open bank accounts. So what we did is we got funding from the City Foundation, and we started by assembling a task force. And the task force really was bankers and also a representative sample of our membership. And we really wanted to find out what were the bank account opening procedures that are currently in place, and what were some of the issues that our members, their clients were facing. And so one of the big findings is that 75% of the nonprofit practitioners within our network that we surveyed said that they themselves were very dissatisfied with their own knowledge. Just like Chi-Chi said earlier, the whole issue of ChexSystems, many of us are not familiar with it. And so if they're not familiar, how can they assist their clients, and how can they really help their clients? And so that was sort of the main takeaway that we got from our membership. This is not working very well. Here we go. This is just an example of one of the slides that's within our training. And what we ended up developing was 2 different modules. They're all self-directed, and I'm going to show you in a second how all of you can access this. It is in a public area under consumer resources on our main website, creditbuildersalliance.org. And so the 2 different modules from one of them were very, very specific about ChexSystems. We want to show people, like this slide really indicates, what the report looks like, what kind of information is on it, how long do things stay on it, how do you get the file, how many of you know what website, what URL to go to get a copy of your ChexSystems? Okay, wow. And this is a room, right? This is a room of people that work in this area. I must admit, I didn't either. And so actually, to let you know, it is consumerdebit. Can't see anything anymore, .com, yes, www.consumerdebit.com. But that's just an example of what's on one of the slides. And so some of the challenges for our nonprofit practitioners, and we talked about this in other panels earlier today, is that there's a lack of standardization, right? And so there's not only just one issue that clients are facing, they're facing a whole multitude of challenges. So one of our members might be working with someone that is a victim of theft or has had some issue that they need to resolve. And so everyone has their own individual issues that they need to surmount. And then also the financial institutions themselves have different processes for opening accounts and different underwriting criteria and so forth. So sort of, again, lack of standardization. And finally, the overarching need was the need to have better resources to be able to help them in their financial coaching and to give direction to the nonprofits, the clients that they served. And so these were the 2 modules that were created. The first one is demystifying account opening. So we really wanted to separate sort of 2 different areas. And first of all, we wanted to talk about just account opening. Are they going to be prepared? What kind of ID requirements? What kind of reports are they going to be pulling? And so we really get into that area. And then the second one is really taking account. And that's where we really get into sort of the nuts and bolts of ChexSystems. We did work really closely with FIS That's the parent company for ChexSystems in developing all of these modules. And again, you just go to our main website and you click on Consumer Resources and you will find it. But we also have made it very easy within this whole training. We want people to be able to, just with a click, be able to find the website that you need to get to in order to get a free copy of your report. We also wanted to point out, we have a really cool banking action plan. So it's actually a form that can be downloaded and can be used by a practitioner, and it's we call it a banking checklist. So if you're sitting down with someone who's unbanked, we have all these steps that they need to go through. So the first step, is a bank account right for me? It may not be. You know, not everyone is in a position where they should or could be banked. Step 2, can I open a bank account? So that gets into, you know, do I have anything on ChexSystems that's going to prohibit me and so forth? How do I get a copy of the report? Step 3, if there are things on ChexSystems, what do I do to improve it? And so, you know, I think that that's really critical because, you know, if you find out that someone is on ChexSystems, so what? You know, how do you help them? And I think that's the critical piece because you've got to sort of deal with that situation. So we have a whole sort of process that they can go through. If there's something incorrect, we tell the counselors how to deal with a dispute. Once they confirm the information, if it is accurate, they would work on how do we work on a plan to repay the debt in full. And so there's more steps. I don't want to get into all of them, but the important thing is that there's actually steps that exist to deal with a ChexSystems. And so with that said, we also have links to more resources, anything you could ever want to know about FCRA, Bank On, identity theft, a variety of areas that are sort of tangential, but also, you know, interrelated. As I said earlier, clients have a variety of different issues, so we wanted to sort of think about anything that could be helpful in making all the resources in just one-stop shop. And then finally, we have some really neat videos, really short videos. There's nothing better than hearing from practitioners themselves. I mean, hearing Nancy's experiences of working on the ground is just phenomenal. And so we have some little short practitioner videos really talking about ChexSystems and the barriers, and especially how their clients have been able to overcome some of them.
Great, thanks, Dara. That's certainly a lot of great really tangible tools that people can use to address these issues. So I want to get my question in. As you heard in my introduction, our office supports the President's Advisory Council on Financial Capability for Young Americans. And we know that young people, whether they're teenagers or young adults, are really the segment of the population in many ways facing the greatest financial challenges. Unemployment is high, people are dealing with student debt, whether or not they have a degree, and they are largely, or at least disproportionately, outside of the financial system. So I'd like to ask each of you, what trends are you seeing around young people in particular in financial access, and what do you think either solutions that you're currently implementing or you think things that could work with those populations? Lee, do you want to? I'll let Lee start.
That's a very timely question. So we partnered this year with the Cities for Financial Empowerment Fund over the summer to really look at the situations with summer youth employment, and actually we'd like to expand that now into all youth employment. My boss, Jose Cisneros, is actually the vice chair of the President's Council, and we just spoke there last week about this very issue and calling for more clarity around account opening procedures for young people. From the city and county perspective, we enroll about 7,000 young people into summer youth employment every year, and of course that means it's their first paycheck, and we don't have all of the information yet, but I do know that one of our partners did just a really quick study survey of all the checks that they'd issued in their program and found that about 45% of them have been cashed at a check cashing place. And so for us to be putting our young people into a situation that they're taking their first paycheck, which comes, from a program that the city and county has jurisdiction over, and then taking that to a check cashing place instead of to a bank or credit union or onto a prepaid card is highly problematic. So we'll be looking more at those issues over the next year, and I think the CFE Fund will be putting out some interesting information about that. This was a 5-city pilot program that really delved into these these issues across the country. So one of the things I think we would like to see is a bit more clarity around what are the rules and regulations around opening accounts for young people, particularly those under age 18. I think on a previous panel, the issue came up around identity theft issues for young people and having had accounts opened in their name by parents or foster parents. And that's another issue that we have raised with the President's Council in our Cities and Communities Working Group, and I know the CFPB is working on. So there's a whole range of issues there that we would like to do more about in our community, and we'll kind of get going on that over the next 12 months.
Roger, is that something that you've been thinking about at the bank, and any thoughts there?
Well, we notice, and we are offering some of our access accounts to, people that are turning 18 and this is their first account, because again, we feel we have the right guardrails to prevent it from getting into trouble. But we're finding out pretty much the same thing, where some of these guys that are turning 18 years of age and are opening an account for the first time, somehow they're on ChexSystems already, which is alarming to us because they're not aware of ever having an account, but yet they're on ChexSystems, and usually they're in there because of fraudulent reasons. And again, it goes back to what you just mentioned, saying that maybe it was a relative who was using their information, or somehow somebody got access to that information. For now, this person is responsible for fixing that problem, but sometimes it's really hard to find out or point them in the right direction for them to fix the problem because they have no idea. I think one of the things that I heard was that sometimes when you're trying to fix the problem, the first thing they're asking is if in fact was fraud, we need a police report. So you need to file a report against mom, dad, older sibling, or uncle, whoever used your information, and you know that these individuals are not gonna do that because obviously they're these family members that or somehow got access to the information. So then, what do you do after that? So we know that there's things like that going on. We don't have the answers for that. We just try to help as many as we can with the access account and letting them open an account if they're on ChexSystems. But once they're on ChexSystems because of fraud, it's hard for us to go any further with them.
All right. There are two major initiatives that the FDIC has underway on empowering youth to engage with the financial system. The first one, I can plug CFPB, our sponsor of this event. We are in a joint endeavor with CFPB to develop curricula for 4 different grade levels. Some of this is renewing what the FDIC has done with Money Smart over the past 10 years, but we are enhancing and refining our youth curricula together with CFPB and putting that out on a website. But we're going further. CFPB is helping organize a parents and caregivers website. We are organizing a teachers website, and we're getting tools together that address the whole family, and we're getting tools together that address the needs of the teachers, particularly with regard to the new kinds of curricular requirements that they're facing. So that's a major initiative. The pre-K to 2, grade 2 is out there in a pilot version. The rest will be available in early 2015. In addition, the FDIC has initiated a youth savings pilot together with 9 banks. We had a competition to really try and explore in depth what makes an effective savings program for young people in the schools. And we'll be looking at that over the next year. We'll also have a phase 2. The phase 1 is really existing programs, and phase 2 is going to be sort of new initiatives. The youth savings pilot is going to focus on the connection between having a product, having an actual savings account available, and having the education. So we all know that financial capability needs to bring both of those things together, and this is an effort by us to really bring that into the school system. So stay tuned. The details on this initiative are all on our website at fdic.gov, and we encourage you to keep informed about it, and we'll probably be bringing out reports and other information in the near term, including some information on relevant policy and process guidance that we hope to gain by working with these 9 banks.
Sarah, do you want to talk about that? I know you've been thinking about it, not just in terms of account access, but also in terms of credit.
Yeah, absolutely. I'm on Experian's Credit Advisor or Consumer Advisory Council, and so because of that, I'm able to stay abreast of a lot of the larger trends in the credit world. And sort of the results that I've heard from Experian have been echoed by other credit bureaus like LexisNexis, and these are some of the trends that I've been seeing. There is the lowest rate of car ownership among young adults ever. I think since the cars were created. Lowest level of home ownership among young adults. Lowest decreasing percentages of young adults using credit cards. They use debit cards instead. And so what does this say? Earlier I talked about the term credit invisibles. We're finding a lot of young adults are credit invisibles because they're not part of the credit system. Recently I met with Holly Petraeus and her team at the CFPB, and she told a story about a young serviceman at one of the bases who was very proud of the fact that he never used credit at all, that he paid cash for everything, and he had saved up a really good amount of money for a down payment for his first house. And she said, this is great that you have money for the first, for this down payment, but who's going to give you a mortgage, right? So it goes back to, if you don't have any credit, you can't get credit. And so I think that that's something among this population that should be a cause of concern. It's also a cause of concern for sort of our greater economy. If no one's buying cars, if young adults are not buying cars, or if they're not buying homes, what does this mean, for the economic stability of our country as a whole? But I think that there are many resources for young adults out there and other credit invisibles. Many of our members offer credit builder loans, which are specifically for people that don't have any credit whatsoever. And so they'll be able to get a small dollar loan, usually just a couple $100, and by being able to pay it back over time, they're able to generate a credit score. The good news is that if you are credit invisible and you do have your payments reported, usually with FICO, you can generate a credit score by 6 months. With Vantage Score, they say by 3 months. So we're not talking about a long wait, in order to be able to be scoreable. But I think that this is something that we should be concerned about, just sort of the lack of credit usage among young adults.
So the other panels did this, and this wasn't in my pre-existing questions, but I think the other panelists got an opportunity to each weigh in on what they'd like to see change to broaden the opportunity for people to access financial institutions. So I guess I would ask each of you to kind of think about, what do you think can be done to make this ecosystem more accessible to more people? And also I'd ask you to think about not just what government can do, but what are the leading practices that you think the private sector can engage in, nonprofits can engage in, levels of government can engage in, so that we are really broadening, not just broadening opportunities to open a bank account, but really broadening opportunities, really a pathway to greater financial stability. So I'll let Dara start.
Oh, no.
How about, are you ready?
Oh, I thought I was going to have time to come up with this. Great, it's all right. It's all right. I was just thinking back to just some of the recent changes in the credit reporting industry. Talking about not weighing small balances that are there, collection balances, sort of just getting rid of them. And I'm just wondering if some similar practices can also apply to ChexSystems and regarding bank accounts. If, for instance, you have a charge-off that's on ChexSystems that's under a certain dollar amount, can it go away or not be weighted so heavily, or maybe re-looking at that 5-year mark? I know with credit scores that the farther away you are from the time when the incident happened, the negative happened, it's weighed less heavily. Maybe looking at some of those best practices from the whole credit reporting industry and applying it with ChexSystems. So anyways.
So this was not on the list of questions that was shared in advance.
You're not allowed to answer.
So I get to say that these are my views and not necessarily the views of the FDIC. I think I can say that one of the things I have colleagues in the audience today as well, that we're here to listen and learn today as well. I think the answers continue to emerge from these wonderful panels. I do want to say that one of my favorite things about my job is that I work with community coalitions across the country. We organize something called the Alliance for Economic Inclusion in targeted markets, but we also work with a large number of bank-ons. We work with a large number of sort of informal bank community alliances, and we work with individual community organizations. We've worked with Dara and her group to bring credit builders training to 4 of the Alliance for Economic Inclusion participants. So we are on the ground as well as up here in Washington, and I do think we need to be responsive to what we're hearing from the ground up. And I'm very glad that that's what's happening today, that we're listening to what's happening on the ground. One of the important things that we've learned is that we need to continue to connect low and moderate income people to financial knowledge at the times and places where they want it and need it. And we need to continue to promote access to financial products that are specifically designed to meet their needs, to meet a broad range of needs, like the ones we've heard about today. So those are 2 things we feel strongly about. And we need to really tailor it to the community. In Kansas City, we have an alliance that's been very active both in youth and in targeted LMI areas of economic inclusion. The alliance has just started a new initiative where they're identifying employers of LMI people in the core urban areas of both Kansas City, Missouri and Kansas City, Kansas, identifying employers that are very likely to have LMI folks working, going into those employers, trying to link their employee base to existing financial capability partners that have financial opportunity centers or Goodwill or other folks who are working on the ground, linking them to those resources, and also encouraging direct deposit. So it is a way of sort of framing those collaborations very proactively. And so I think that also is an important part of the solution.
I guess from my perspective, and these are in my opinion, is there's 2 things. We would like to have more consistency of data from the CRAs to make sure that we can all understand what's in there and why customers been reported to ChexSystems or other institutions or systems. But most importantly, I think, is that we would like to have a clear process in place where when a customer is attempting to open an account and they're unable to because they were reported by one of these agencies, that they can go through this process and clear things up without having to be told to go to different places or making different phone calls or making payments back to some of the institutions, but yet not correcting the problem. That'll be my number 2 opinion or recommendation. And number 3, have it done in a very quick way where they can do it fast. We know that this is a bigger problem and that we cannot solve it, but we're trying to, as a bank, trying to help the LMI customer to have access to an account. And by changing some policies where we allow customers to open a checking account, although they were in ChexSystems, and the checking account was created to have those guardrails, we can make that happen, but I don't think we can do that for many more millions of customers that are in the same situation. So by making those changes in policy, it can help us, but I think there's definitely opportunity for more.
Great. Lee?
Yeah, so I'd like to add a few thoughts. I think definitely I came into this to this session today feeling very confused about how to help and advise consumers, and there hasn't frankly been much that's been said that's made me feel less confused, I think. And the thought that we can make this a consumer education issue when a room full of experts doesn't even have clarity around how to resolve these issues doesn't really seem practical or fair. I think one of the things that when I mentioned earlier about the disconnect between the enthusiasm of the banks and credit unions on the ground for helping people in the local community and then the barrier of having those accounts closed by corporate headquarters really, I think, is a good illustration of what the problem is. So I would like us to convene nationally, and I'm going to put in a shameless plug now for the BankCon 2.0 convening, which will be held here in Washington, D.C. on November 6th. on the local level, we've done a lot. There's more than 100 bank-on programs now across the country. We've got municipal governments involved. We've got community groups involved. And I would say that we're doing all we can. This has been met with great enthusiasm by our financial institution partners, but we still are running into barriers. I've helped launch a lot of bank-on programs, and this issue about second chance checking or resolving these screening issues is number one. It's first and foremost, and we don't have a good solution because we can't solve for this locally. So I'm going to suggest that you all sign up and join us on November 6th to discuss this and many other issues about the future of what we can do together, because we really need to elevate this to the next level. There does need to be policy change and regulatory change and a lot more clarity. If we're going to be marking people for things like fraud, that's a pretty serious accusation. And if we have any concerns that that's being done inconsistently or unfairly, I think we have a duty to take action on that. So we look forward to continuing the conversation and seeing what we can do on the national level to support those of us working locally.
Great, thanks. I know some of you have questions, and I think Sarah will facilitate our discussion and questions.
Yes, thank you so much to the panel. So same drill, please identify your name, your organization, and if you want to direct the question to one of the panelists, please do so.
Wow, either this panel is that good or lunch was that good.
So lunch was delicious.
People are a little...
We have one right here.
Hi, I'm Shamir, co-founder and CFO of Simple. So there was a recent agreement between Capital One and the New York Attorney General, under which Capital One basically agreed to eliminate ChexSystems usage, and I think one of the panelists on the earlier panel mentioned that. I believe that the justification there was the disparate impact of using ChexSystems. As we've all heard, it disproportionately eliminates low and moderate income people from access to banking services. Do you guys actually think it's a good idea for all banks in the country to stop using ChexSystems and just make checking accounts available to everybody, regardless of their previous history at any other institution?
Anyone want to answer that?
Someone has to. I don't know. That's probably not a good enough answer to the question. Well, I think what I've heard today, I mean, a system of information sharing is only as good as the information that's being put into it, right? And it seems that there's so much inconsistency in the information that's being put into the system that even from a financial institution perspective, I would be questioning the validity. However, we did hear loud and clear when we started Bank On that financial institutions do have the right to protect themselves from fraud and from criminal activity, or from people who may be abusing those systems. So I think we need to find a better solution than the one that we have right now. I don't know if I go so far as to say that, but I don't know. Perhaps Roger has a different opinion.
Actually, I don't. I think that it has its purpose, it serves its purpose, and I personally don't see any reason why we should be moving away from that. I just think that just like any product, and I'm speaking as a product manager, there's always a way to enhance or improve whatever product, process, or system we have in place, and I think the opportunity is just there.
Other? Over here.
Hi, I'm Ruth Susswine with Consumer Action. It sounds like from the first session till now, the issue of fraud keeps coming up, that it needs to be better defined, and it seems as well that, I guess I would direct my question to Roger to say, so you've said if a consumer says it's identity theft, and this fraud is not my fraud, that your bank at least is stopped in its tracks in helping this person open an account. So my question is, what do we do for these consumers? If we all, everyone seems to agree there's an issue with fraud, so how do we actually help these people become part of the system?
Well, from our perspective, we rely on the record that we get from our provider. If the record comes up as fraud, we have to ask the customer to go ahead and deal with that. Usually what happens is that what we're finding out is some of these customers have problems with banks that are no longer in existence. There's been banks that were acquired. So then the first thing that the customer needs to do is reach out to Bank A. And Bank A says, well, I don't know who was Bank B. We acquired them, but we don't have no record of you. So it's really hard for the customer to go to the other bank because it's no longer in existence. The new bank doesn't know anything about that customer. So then it goes back and forth, and then they go to ChexSystems or whichever agency the negative reporting is, and they're saying you have to deal with your bank, whoever reported them. So we're kind of like trying to help them out, but we're unable to say, go ahead and fix it because it's really hard for the customer to fix this problem. So we're limited on what we can do to help the customer do that.
If a consumer were then to dispute that information, is that something that your bank would be able to address on a one-on-one basis?
No, we couldn't because we have no idea what transpired between the customer and Bank A or B or whatever. We have no clear information what was the reason for being reported as fraud. We only get a flag that tells us, account was closed due to fraud. And that's kind of where we are.
As others gather their thoughts, I'll just mention our experience at CFPB was similar to Dara's in that we heard from a lot of practitioners who were interested in more information, and there was a lot of confusion about how to help clients. And so I'll put a shameless plug in for a toolkit that we developed, Your Money, Your Goals, which includes some basic information about banking account history, barriers to opening accounts, and steps for consumers to take if they have issues. So that's available. It's obviously free. It's on our website. And that might be a good tool for practitioners, as well as the tool that Credit Builders Alliance put together.
I think it also speaks to the need that we are still in an area where there is opportunity to innovate in financial products and services. I mean, I think we've got a lot of great products coming out of building on the FDIC's Safe Model Account product, but I think there's also a lot of opportunities still for innovation using technology, using mobile-based products and services that can help people better manage their money, better manage an account. And obviously there are financial institutions that have to be willing to try these things, but hopefully we're creating an environment across the regulatory agencies, across other partners in government, where constructive innovation and safe innovation is something that is, certainly something that is welcome in order to meet the needs of, the many millions of Americans who are not currently being well served.
Just a comment too. When we talk about being, sort of outside of the mainstream financial system, we all know how costly that can be. But one of the things that keeps coming across over and over and over when you look at some of the research and data that's been done through like the Financial Diaries Project, talking to our members about their experiences with their clients, is that if you are outside of that mainstream financial system, you spend a huge percentage of your day just doing financial things, right? Because you're driving somewhere, you're having to, get a cashier's check, you're then driving to this other place to pay your utility bill before it gets cut off. And so, I think that that's a huge benefit that we haven't talked about today, but, there's so many benefits of being pulled into the mainstream financial system that I think it's really incumbent upon us to try to make the barriers less than they currently are. If you can lessen the time, running around your car, doing all of these things that many of us just do sitting, at our computer, paying our bills, then what does that do? It opens up time to do a whole host of other things. And so I think that, if we're talking about holistically, Louisa said, this is much bigger than just talking about ChexSystems. I think we're talking about like quality of life, and this is something that if you become banked and part of the mainstream financial system, it really improves your quality of life.
Are there any other questions? Okay, please join me in thanking our panel. I'm I'm now going to hand this over to Daniel Dodd Ramirez, Assistant Director for the Office of Financial Empowerment at CFPB.
Good afternoon. Before the panelists leave, let me just give some instructions for the rest of the afternoon. So you've been sitting very patiently, and after eating, we know that everything, the energy really starts to go down. The panels have been wonderful, but now we're going to get you up, and we're going to get you into some breakout groups, and we want to hear from you. We're going to continue the discussions that we've had, and continue some of the questions that we've had in a more informal setting. The live streaming portion of this event will end now. And let me just go through an explanation of what we're going to be doing next. Again, my name is Daniel Dodd Ramirez. I'm the Assistant Director of the Office of Financial Empowerment at CFPB. The Office of Financial Empowerment is the office which focuses on economically vulnerable consumers. That we equate that with anyone that's above 200% of poverty. Living in the United States, we know there's about 100 million people that fit that definition. Our office is tasked with really focusing on those consumers and looking at how to get them products and look at making them more financially capable, especially products which are safe, affordable. A lot of the things that we've been talking about affect them disproportionately. There's a couple of other offices I just want to mention real quick within our division, which is the Consumer Education and Engagement Division. One which has already been mentioned is service members, another is students, and then the other one is older Americans. And you can read more about them on our website with the CFPB website. So again, thank you all for participating in the 3 morning plenary sessions. I know that we were all able to get a more comprehensive understanding of the check screening ecosystem. We heard from financial institutions, large and small, community-based, regional and national, that are trying to balance risk and access. We heard from credit reporting agencies that are charged with receiving, holding, and transmitting information about consumer banking history. We heard from advocates and service providers about the consumer experience and innovations in the field to help consumers to get into account products that are safe and beneficial. And finally, we heard from others in government, including our fellow regulators, who are working hard to help provide clarity, transparency, and fairness to all the players in the ecosystem. This afternoon, we are transitioning to these 3 breakout sessions with the express intent of fostering further conversation among all the players and with the goal of increasing understanding about each other's interests and roles. Hopefully, we'll be surfacing new ideas about how we can work together to make the system work better for consumers and for institutions as well. There's always a temptation to leave early. We hope that you resist that.